Now this week, how to make 1,000 ringgit work for you. Yeah, earning passive income does not always require a huge capital, contrary to popular belief. So we will go through 8 options and I'll list out the respective pros and cons of each option to hopefully give you guys a good idea on where to grow your money. As usual, not financial or legal advice. So before investing, you must ensure that you have these two things sorted out first. Yeah, your emergency funds, make sure you have at least 3 to 6 months worth of your expenses. Yeah, let's say you spend about 2,000 ringgit every month for your groceries, utilities, etc. Then you need at least 6,000 ringgit ready to go in your bank account or stored somewhere safe that you can liquidate immediately in the case of an unfortunate event. Now, in the case of insurance itself, you don't have to get an investment linked plan. Yeah, you can buy the insurance just for the protection itself. And normally, a medical insurance is most commonly required. And these two options will ensure that you have a peace of mind before you start investing, so that you do not have to liquidate your investments prematurely during an unfortunate event. Yeah, let's say touch wood, this person is currently invested in the US stock market, or perhaps they bought a bit of Maybank stocks. They do not have any emergency fund. And when their car breaks down or whatever, they are forced to liquidate their investments in the US stock market, forced to sell it at a loss. And at the end of the day, this is what we don't want. Now, low risk options. Fixed deposits, the current rate is 3.5 to 3.75% per annum. Make sure you check with your bank, because normally your banks they are quite stingy one. The rates that they provide is about 2 to 3% only. The only way to get this promo rate over here is by checking whether the bank is offering any promotions or not. And very often the requirement is to transfer fresh funds from a different bank account under your own name. Yeah, so it's wise to have like 2 to 3 bank accounts so that once your tenor is up, you can switch the funds over to another bank account that has a much more attractive promotional fixed deposit rate. Okay, so now in terms of FDs, right, it's safe and predictable, the returns are guaranteed, it's insured by PIDM, Sharia compliant, it depends. Okay, so if it's EFDI, as long as there's an I in it or the word Islamic in it, then it's definitely Sharia compliant. But the con of this is that sometimes the returns can be quite low. In fact, it has been declining recently. Just 1 year ago, the highest rate was about 4.2 or even 4.5% per annum. And it requires a significant capital to begin investing. Most commonly 1,000 ringgit. And most of you will ask, nowadays there are so many cash apps out there. There's Versa, there's KDI Save, then there's Stashaway. And all of these cash apps, the returns they're giving is much higher compared to FDs. Then what makes FDs attractive? Well, the thing you got to know about these cash apps is that the returns are not guaranteed and they often fluctuate. So give you an example of Rise. Previously, just over a year ago, maybe less than a year ago, their earnings rate was at 5% per annum. Then they reduced it down to 4%. And most recently, they reduced it again to 3.8% per annum. If you manage to get a fixed deposit last year or 6 months ago at 4% per annum, and now Rise, their earnings rate has reduced to 3.8% per annum, you can see that suddenly fixed deposits become more attractive, right? So in the case of cash apps itself, right, there are so many apps these days. All you need to do is download any one of these apps to begin investing and take a look at the respective pros and cons. So moving on, next one. This one is ASB and ASM. Now ASB, ASM, also another classic. The returns average about 4 to 6% in the past 5 to 6 years. Now the reality is that the returns are declining, okay? But even when the returns are declining, what you notice is that never was there a year that ASB and ASM has delivered negative returns. Right, so this is what really makes both of these options very attractive. And the rates they provide are still pretty high, right? It's actually much higher compared to traditional fixed deposits and even higher compared to cash apps, right? The 2023 dividend for ASB came out at 5.25% and ASM 4.75%. Now, the only con of ASB and ASM is that there's limited units for non-boomies. And non-boomies can only invest in ASM, and very often it's difficult to acquire units. But right now, ASM3 is offering each individual a quota of 100,000 ringgit. So this is not a pooled quota, okay? Everybody has a quota of 100,000 ringgit until the 26th of April 2024. So if you're ever wondering, or if you did not have the chance to invest in ASM, then now might be a good opportunity to invest in ASM3. Because ASM, ASM2, ASM3, the assets that they invest in is pretty similar. The returns are also relatively similar. Okay, so if you didn't manage to get units in ASM, you can opt for ASM2 or even ASM3. Now to start investing, just download the My ASMB app, just register, key in your IC details, and then the system will determine whether you are Bumiputra or not, and you can start investing accordingly from as low as 10 ringgit. Now to the medium risk options. We'll start with gold. So gold, it has been with us for thousands and thousands of years. In fact, back in the 1970s, before the 1970s, the United States used to peg the US dollar to gold. I'm sure some of you guys are familiar at the $35 an ounce before they abolished it entirely in 1971. So gold is attractive because it's valuable. Okay, not just monetary wise, it's valuable in jewelry, in technology also, right? All of your tech gadgets as well as the computer chips will definitely use gold. And in the past 5 years, it has given a return of 7 to 10% per annum. Not insured by PIDM typically, but in the case of Sharia compliance, right, it entirely depends on what type of funds that you invest in. So there are many options to invest in gold. You can buy gold directly. You can also download an app to invest in gold, like Bursa Gold Dinar over here. Start from as low as 10 ringgit. Now this one is Sharia compliant. Or you can buy index funds that track gold. Okay, now this one can be done through regulated brokers such as Mumu, Rakuten Trade, or even M Plus Global. Gold itself, from $35 an ounce in 1970, 1971, has obviously rallied significantly. Right now, the price is at its all-time high, about $2,200 an ounce. But still, portfolio managers, they generally recommend not more than 10% of gold in your portfolio because it is used to only diversify your holdings and sort of like keep track of inflation. Well, why is this the case? Well, because this asset depends on when you invested in it. Now, the returns can vary significantly depending on when you invest. I'll give you an example. Let's say you went all in gold in 2012. Okay, after like a decade later or more than a decade later, the total returns that you get is only 14.4%. Now, some of you may say that, hey, not bad, what? But actually, it didn't even keep track of inflation at all. Okay, and from 2012 all the way down to 2016, gold actually fell by almost 50%, showing just how volatile this asset can be. And if you manage to invest in this low over here, you'll be up by 110% right now. Okay, so this is why when it comes to slightly higher risk assets like this, limiting your exposure is key. Let's move on over to bank stocks. They pay very generous dividends. Maybank sometimes 5 to 6%. Last year 6.27%. CIMB 5 to 6%. Last year they paid, if I'm not mistaken, one of the all-time high dividends, 6.71%. Yeah, they pay very steady dividends twice a year, and their share price is also deemed to be relatively stable. They are cyclical stocks that tend to fluctuate in a certain range. And the thing that makes banks very attractive for retail investors is that a lot of institutions have big money in it also. Take a look at EPF's top 5 equity holdings in Malaysia. 4 of them belong to banks. Maybank, then Public Bank, then RHB and CIMB. So to begin investing in any of these banks, right, you can do it through regulated brokers. Okay, this one is either Rakuten Trade, Mumu, or even M Plus Global. So these are just the well-known brokers. Obviously, there are so many brokers out there in Malaysia. Now, let's move on over to the high-risk options. This is aggressive mutual funds. Typically, they are not insured by PIDM. And Sharia compliance, it depends. Okay, the funds will typically state whether they are Sharia compliant or not. When it comes to high risk options, right, long term is obviously the most optimal option. Okay, you must have a time frame of 10 to 20 years because the assets are quite volatile. And nowadays, you can invest in mutual funds quite easily. Touch and Go Invest, they provide over 10 types of different types of funds that you can choose from. So this is just 2 examples. Principal Global Titans Fund, you can decide what sort of exposure that you want. Okay, let's say I mainly want exposure into the US market. Okay, then this fund may be for you because it has its top holdings in Apple, Microsoft, Amazon, Nestle, etc. Also has a bit of exposure in Europe and Japan global titans, right? Next one is Principal Daly Global Equity Fund. This one is also Sharia compliant. And if you want some global exposure such as BNP Paribas, Comgas Growth, yeah, you decide for yourself. Okay. So the only thing that you got to take note of is the fees. Typically, these funds they do charge annual management and trustee fees as well as upfront costs, except for Versa. Versa currently they do not have any upfront sales charges, but in the case of Go Invest, right, they do charge like a 1.5% when you begin investing. So 1,000 ringgit off the bat, you lose 15 ringgit already. Now, in the case of public mutual itself, right, the upfront cost can go as high as 5%. Yeah, so make sure you select the fund that has steady returns, yeah, the returns are steady, as well as lower fees, lower annual fees and lower upfront costs. Now let's move on to the next option. Now this one is investing in US stocks or ETFs. So typically, when it comes to investing in the US market, more recently, it has become more and more attractive because of the free fall of the Malaysian ringgit, right? Which is why it makes sense for us to diversify into global assets, as well as assets that are denominated in strong foreign currencies, such as US stocks and US ETFs. Now, I don't handpick US stocks. Okay, I don't buy Apple, I don't buy Netflix, I don't buy Google. I buy the entire US market. Okay, so this is my thought process over here. Why have one company working for you when you can have 500 or 100 of the US largest companies working for you? Now, when it comes to ETFs, right, there are many types of ETFs that track the S&P 500 index. So the candlesticks over here, that's the S&P 500. VTI, that's the blue one over here. You can see it moves almost one-to-one. VTI, I think, invests in approximately 100% of the US stock market. Then there is also QQQ, which is the orange line over here, pretty much one-to-one also. This one invests in 100 of the largest non-financial companies on the Nasdaq. And all of these ETFs, right, they are listed on regulated brokers. The only thing that you got to compare is the fees of each broker. Now, I've done quite a detailed comparison of Rakuten versus M+. So spoiler alert, Rakuten is the winner, but I have not done in-depth research on Moomoo just yet. And I've heard that Moomoo is quite attractive because right now, if you deposit 8,000 ringgit and above, you get 900 ringgit in Apple shares, which makes it quite attractive actually. So let's move on over to the final option. Now this one is extreme risk, it's off the charts, okay? And it's cryptocurrencies, specifically Bitcoin or Ethereum. Now, just by looking at this chart itself, right, you can really see how volatile this asset has been. From its previous all-time high of $69,000, it fell by 77% in less than 1 year, all the way down to 15,005. Yeah, because of the bear market, right? Then after that, it quickly rallied back up in less than 2 years by almost 400% to a new all-time high of 73,006. Now, because of the sheer volatility, right, and the extreme risk, right, portfolio managers, they generally don't recommend more than 1 to 3% of exposure in crypto within your portfolio if you're a low risk investor. So let's say you're a low risk investor and currently your portfolio is about 10,000 ringgit. And the maximum that you can allocate in Bitcoin, 3%, is only about 300 ringgit, Yeah, because this asset is really just so volatile. If you're a high risk investor, maybe you can go up to high single digits, maybe 9 or 10%. So if your portfolio is 10,000 ringgit, up to 1,000 ringgit, you can allocate in Bitcoin in itself. Now, why I say you got to watch your allocation and keep it limited is because of this chart over here. Now, at a 10% loss, right, let's say your $1,000 becomes $900, right? You got to make 11% in order to gain back your capital. But this difference only increases significantly. Let's say if you lose 70% of your funds, 1,000 ringgit becomes 300 ringgit, then you have to make up 233% more. You have to gain 2.33x in order to gain back your capital. Yeah, if you lose 90% of your funds, it becomes 100 ringgit or $100, then you have to make a 9x gain in order to gain back your capital. So don't be fooled by this percentage over here. Even though it's 77% loss and a 400% gain, actually is a bit deceiving. Okay, which is why when it comes to risky assets, limiting your exposure is key. So crypto, where to invest? Well, obviously the most well-known one, regulated by the Securities Commission, is Luno Malaysia. I'm sure you guys have heard of it before also. Currently, I think they are capturing over 80% of crypto trades in Malaysia, maybe more. But there are other exchanges also. You can take a look at this list over here. Just make sure before you start investing in any cryptocurrencies, right? Make sure the exchange is regulated by the Securities Commission. Yeah, otherwise, if you run into any trouble, you cannot claim back your money, you cannot sue anyone. So I do want to elaborate more about the risk-return trade-off. How I determine risk in this presentation, right, is based on this trade-off. Yeah, lower risk, typically lower returns, higher risk, higher potential return. You can see that I highlight this word over here, right? Yeah, that's because the returns are not guaranteed. No investment can guarantee returns. Doesn't mean that today you invest in a higher risk asset, you are guaranteed to get higher returns. No, it's only higher potential return. Yeah, so make sure you consider this risk return trade-off before you start investing too heavily or too much into a super high risk assets. Now, a bit more about the rule of 72. This one is actually a useful tool for you to estimate your future returns. So you take 72, you divide it by the rate of return, then it is basically the time taken for your funds to double. So let's say today you have 10,000 ringgit and then you don't plan to add or remove any capital. Okay, just leave it there and you expect your portfolio to grow by 5 to 6% every year. And in this case, it takes around 12 to 14 years for that 10,000 ringgit to become 20,000 ringgit. So yeah, I've come to the end of my presentation already. Hopefully it gives you guys a good insight on where you can start investing your first 1,000 ringgit. And in fact, right, all of these options that are listed out today, except for fixed deposits, the requirements are sometimes much lower. Yeah, for cash apps, you can start from as low as 1 ringgit. Yeah, Stashaway Simple allows you to deposit minimum of 1 ringgit only. Okay. Meanwhile, ASB, ASM, the minimum is only 10 ringgit. For gold, right, in the case of Bursa Gold Dinar, the minimum is 10 ringgit only. For some gold funds, sometimes the minimum can go up to 100 ringgit. Now, in terms of bank stocks, this one is a case-by-case basis, depending on which specific stock you invest. Because Malaysian stock exchanges, they typically only allow you to buy shares by the lots or by hundreds, meaning every time you buy, you got to buy 100 shares of Maybank. So equivalent to 957 ringgit or 428 ringgit, so on and so forth. Then in terms of like aggressive mutual funds, sometimes you can start as low as 10 ringgit or even 100 ringgit. And the ETFs itself, you can begin from as low as 100 ringgit. Obviously, if you have lesser amount, then the fees will be much higher. Okay? If you have more, then the fees will significantly decrease. Next question, saw the historical returns for QQQ from 2000 to 2003. Huge negative returns. For this case, how could we maximize our returns? Just to DCA. Based on your experience, how long would you DCA once? As we will lose some amount of money in terms of currency exchange, platform fees, broker fees, etc. So when it comes to this, right, I would say consistency is key. Okay, even though from 2000 to 2003, the returns of QQQ is massive, but compared to right now, right, it's almost a blip. You don't even notice the huge drop, Okay, let me just scroll back to a week chart over here. Yeah, sure, the drop from 2000 to 2003 is massive, but compared to right now, right? If you, let's say you sold over here and you didn't believe in the stock market anymore, you'll miss quite a significant amount of gains, okay? Over 1,238% or 12x gains. Okay, so the key over here is consistency and portfolio management. So what I generally do is I fix a specific percentage for each asset within my portfolio. So let's say I'm a 60-30-10 guy, 60% equities, 30% fixed income, 10% crypto. Okay, so 60% equities, it's split between investments in the US stock market, like such as QQQ, aggressive mutual funds and whatnot, local bank stocks, whatever, right? And within there, it has their own specific percentage. And when, let's say, the US market underperforms, right? Like one of these years over here drops by over 20 or 30%, then the weightage of that asset within your portfolio will decrease, right? And this will prompt you to invest more. Okay, so that's one of the ways that you can sort of like balance out the risk in your portfolio because you already determine the specific percentage of where you want to allocate to. Okay, so you don't have to follow my percentage, just determine your own percentage depending on your own risk profile. So just a quick shout out to all our current members. Thank you so much for supporting the Futurists, Andrew, Wendy, Edward, Alex, CC Is, Urshad, Caveman Balls, Calvin, Tommy, Jinkang, Adrian, Jazz, Wenyan, Dean, Duhan, Sufi, Faris, Alan, Jackson, Raizan, Hudson, G, Jeffrey, Lawrence, Lukman, Jack, YC, Arif, and Christy, as well as all of our learner members. Thank you so much for joining. I will see you guys in the next session. Good night. Stay safe. Bye bye.